You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today, we're cutting straight into the core of a really comprehensive global markets and geopolitical briefing. We've pulled together a ton of intel covering everything from, the subtle shifts in foreign exchange, the pulse of commodities, right through to evolving trade policies and, those ever-present geopolitical tensions.
Yeah, a lot to cover.
Our mission, as always, is to extract the most important nuggets of knowledge, connect the dots you might not see at first glance, and reveal what's truly essential to understand in our fast-moving, interconnected world. Okay, let's unpack this for you.
Exactly. And what's striking here, I think, is how these seemingly disparate elements don't just exist in isolation.
Right.
They really weave together, creating a critical, dynamic snapshot of global dynamics.
Mm-hmm.
And understanding those ripple effects is, it's key to seeing the bigger picture.
Absolutely. And to kick us off, let's jump right into some of those fascinating shifts happening in global financial markets, particularly in the ever-active world of currency. Let's dig into the dollar index, because the underlying U.S. data here presents a fascinating puzzle, really.
Mm-hmm.
The dollar firmed modestly, okay, but we saw upward revisions to GDP and sales, classic signs of strength, yet also softer core PCE numbers and stronger jobless claims.
Yeah, it's quite the mix.
Now, core PCE, for those tracking, that's the Personal Consumption Expenditures Index, a measure of inflation the Federal Reserve watches really closely. So, what does this mixed bag mean for the dollar, and how are markets, interpreting such conflicting signals?
It creates a real sense of caution, doesn't it? Markets are definitely holding their breath a bit ahead of the full PCE report.
Mm-hmm.
And that caution is really amplified by what we heard from Fed Governor Waller. He's notably a dovish dissenter, meaning he's typically more inclined towards looser monetary policy, lower interest rates than some of his more hawkish colleagues. Waller's been reinforcing his view that policy needs to shift to a more neutral stance, actually advocating for a 25 basis point cut as early as the September meeting.
Wow, September.
Yeah, and he's even signaling more cuts over the next 3 to 6 months. Now, you asked if markets are buying this.
Yeah.
Well, Waller's a significant voice. And even one Fed speaker with such a distinct view can significantly sway expectations about future monetary policy. It creates this complex environment where, good economic news can sometimes be seen as bad for rates.
So a single influential voice can really move the needle even when the data itself is sending mixed messages.
Interesting. Meanwhile, across the pond, the euro has eased back a bit after hitting some resistance near that 1.1700 level. All eyes there are on upcoming German, French, and Spanish inflation releases.
Mm-hmm. Crucial data points.
And just across the channel, sterling is holding its ground around 1.3500 amidst reports of Prime Minister Starmer's planned cabinet reshuffle and the appointment of a new economic advisor, all happening ahead of the autumn budget. Right. And those European inflation data points are absolutely critical for the European Central Bank. They inform their policy decisions, any potential rate adjustments.
Sure.
If inflation figures come in softer than expected, it could certainly open the door for the ECB to consider, easing its stance. And for sterling, political developments like a cabinet reshuffle, they inherently introduce a degree of uncertainty.
Always do.
Any significant changes in leadership or economic council, especially leading up to a major fiscal event like the autumn budget, can certainly impact currency stability. Markets start pricing in potential policy shifts and their potential economic fallout.
Makes sense. Now, over in Asia, the yen seems a bit directionless after some mixed Japanese economic data. But here's something quite intriguing.
Okay.
The antipodeans, that's the Aussie and Kiwi dollars, are finding some surprising support. They're being buoyed by another stronger yuan fixing from the People's Bank of China.
Ah, the PBoC fixing.
Yeah, the PBoC set the midpoint at 7.1030 against the U.S. dollar. That was stronger than market expectations, which were around 7.1274. That strategic yuan fixing is a powerful lever. How does a single policy decision like that manage to resonate across entire regional economies so profoundly?
It's a fascinating example of strategic currency management, isn't it? The PBoC's yuan fixing isn't just about, say, regional stability. It's a subtle yet powerful signal. It shows China is willing to leverage its currency as a strategic tool for economic influence. By setting a stronger midpoint, China signals a certain level of confidence and stability, which then has a significant ripple effect because of, well, strong trade ties.
Right.
If we connect this to the bigger picture, it suggests a potential recalibration, maybe, of trade flows and even financial alignments, perhaps away from over-reliance on the dollar in the long run.
Interesting perspective.
It's a key indicator, really, of where future economic partnerships might form. And in the meantime, it provides unexpected support and stability for currencies like the Australian and New Zealand dollars.
That's a profound point about economic influence. And for you listening, consider this. If the yuan's strength is unexpectedly bolstering the Aussie dollar, what are the ripple effects? Think about Australian tech companies importing components from Europe, or maybe Australian investors holding U.S. Treasury bonds. These nuanced currency movements aren't just abstract figures. They translate directly to pricing, profitability, and even your investment strategies on a daily basis. So after all that currency talk, what does this all mean for commodities? After some recent gains, we're seeing a bit of retracement across the board.
Yeah, a pullback.
Crude oil prices, for instance, pulled back after what's been a pretty choppy performance lately. And this, we're told, is tied directly to geopolitical developments.
That's right. Crude oil's volatility is almost like a real-time reflection of perceived global stability or instability.
Yeah, it really feels that way.
When geopolitical tensions escalate, the market reacts, driving prices up as supply security concerns grow. Then, when there's any hint of easing, or conversely when, maybe, long-term supply-demand dynamics override immediate fears, prices can pull back quite sharply. It really is a key barometer for global anxiety, and its recent choppiness just underscores how fragile the current environment feels.
And what about other key commodities? Spot gold, often seen as that safe haven, right? It gave up some of its prior advance after briefly breaking above the $3,400 per ounce level.
Sit back a bit.
But copper, that quintessential industrial bellwether, remains remarkably well supported. It's hovering near recent highs on optimism linked to Chinese demand following those fresh liquidity injections into their economy. That's a fascinating contrast. Gold pulling back, copper holding strong. This raises an important question, I think. Is copper's strength a leading indicator for broader economic confidence, or is it more just a reflection of China's internal stimulus?
That's a great question, and it's a critical distinction. Gold's role as a safe haven means its appeal tends to recede when immediate global risks are perceived to be easing, even slightly.
Right.
That allows some of its prior gains to be relinquished. Copper, however, is a different story.
Okay.
Its sustained strength, particularly linked to Chinese demand and those liquidity injections, suggests much more than just speculation. It hints at broader confidence in, say, global capital expenditure. The willingness to invest in long-term infrastructure, and ultimately, the outlook for job creation in sectors tied to industrial growth. This isn't just a commodity price, it's a barometer for future economic health. And that can influence everything from your investment portfolio to the long-term stability of global supply chains.
That distinction really elevates copper's significance beyond just a raw material. It's a signal.
Exactly.
Now let's shift gears to trade. An area that consistently generates headlines and, frankly, can be a little like watching a multidimensional chess game.
Yeah, that's a good analogy.
The U.S. Trade Representative, for instance, extended certain exclusions from China's Section 301 tariffs through late November. Now, our context. Section 301 tariffs were originally imposed under a U.S. trade law to address what were deemed unfair trade practices.
Short-term extensions.
But then, let's pivot to something truly intriguing. White House advisor Navarro announced that the global de minimis exemption will end today.
Right, that's a big one.
With a 6-month transition period specifically for postal shipments.
You've hit on something crucial there. The chess game analogy is perfect. The extension of Section 301 tariff exclusions, that's a short-term, almost tactical measure, suggesting some flexibility on certain goods.
Okay.
But the ending of the de minimis exemption, that's a much more impactful move. For those unfamiliar, the de minimis rule allowed low-value shipments, often e-commerce packages, to enter a country tariff-free up to a certain dollar amount.
Right, under $800 in the U.S., typically.
Yeah, it's exactly. The stated reasons for ending it are, curbing counterfeiting and drug trafficking, while simultaneously creating domestic jobs by leveling the playing field for local manufacturers. But what's fascinating here is how these seemingly contradictory actions, extending some tariffs while ending a key exemption, aren't just about balancing domestic and international goals. They highlight, I think, a global shift towards tactical, almost surgical protectionism. The era of broad multilateral agreements might be giving way to a series of hyper-specific self-interested skirmishes.
Yeah.
And that makes global supply chains increasingly fragmented.
That's a powerful insight, tactical protectionism and fragmented supply chains. It implies a much more complex, less predictable trade landscape for companies trying to plan long-term.
Absolutely.
And speaking of trade friction, in North America, Canadian officials have been expressing skepticism that President Trump will actually remove all tariffs on their country. That highlights persistent underlying tensions, even between close allies.
Yeah, that uncertainty lingers. It shows the challenges in even long-standing economic partnerships, often driven by domestic political pressures.
Meanwhile, in Latin America, Brazil's Vice President Alckmin has stated that trade negotiations on a supplementary agreement with Mexico are expected to conclude by mid-2026.
Mid-2026.
With the signing slated for August of that year.
So in contrast to the U.S.-Canada situation, the Brazil-Mexico deal, with its long-term negotiation timeline, really underscores the strategic importance of these regional trade agreements.
Right.
These kinds of deals are actively shaping new economic blocs and alliances, fostering deeper integration between specific nations, kind of a different global order emerging.
And just quickly, from Japan, trade negotiator Akazawa confirmed he will travel to the U.S. once arrangements are complete for an executive order finalization. And he even indicated a further visit may be necessary.
Yeah, this just emphasizes that bilateral trade efforts are very much ongoing, continuous. Nations are constantly engaging, negotiating to seek favorable terms and, solidify economic relationships amidst these broader global shifts. It's a continuous dynamic process.
It really is. So when we talk about these trade policies, from tariffs to exemptions to new agreements, it directly affects the availability and cost of goods for you, the listener.
Directly.
Think about it. If a key component for your next car is suddenly subject to new tariffs, or if a global trade exemption disappears, it impacts everything from manufacturing costs right down to the price you pay at the dealership. It reshapes entire industries, influences global supply chains, and dictates where products are made and how they get to market.
It really does hit home.
Now, let's pivot our attention to the global geopolitical front, where tensions, unfortunately, remain elevated across continents, and this creates ripple effects for everything else we've discussed.
Yeah, it's all connected.
In the Middle East, for instance, Iran's foreign minister has rejected claims that European powers have the jurisdiction to trigger sanctions snapback measures under the nuclear deal framework.
Right, the snapback clause.
He stated that Tehran is prepared to resume talks if others show goodwill. Notably, Russia and China have pushed back against these European moves at the UN, saying such efforts carry no legal basis.
Okay, the snapback mechanism within the nuclear deal. It's critical but highly contentious. It allows sanctions to be reimposed if Iran violates the agreement. Iran's rejection of European jurisdiction, combined with Russia and China's unified pushback at the UN, that signals significant diplomatic and legal challenges. This alignment of Russia and China supporting Iran's position really highlights a united front against European efforts. It indicates a broader geopolitical axis at play, creating a much more complex diplomatic landscape than perhaps initially perceived.
A united front. That's significant. Over in Eastern Europe, Germany's Chancellor Merz has flat out ruled out a meeting between Presidents Putin and Zelensky.
Yeah, quite definitive.
And European leaders are reportedly discussing the creation of a buffer zone, maybe up to 40 kilometers, between Russian and Ukrainian forces as part of a potential peace plan. Though Kyiv is, understandably, unlikely to accept any territorial concessions.
Well, Germany's decision to rule out a direct meeting implies perhaps a lack of immediate diplomatic breakthrough potential, or maybe just a strategic stance given the current environment.
Right.
The proposed buffer zone is an attempt at de-escalation, clearly. But the significant hurdle posed by territorial concessions makes any peace plan incredibly challenging.
Yeah.
We also saw the White House noting President Trump's unhappiness with recent overnight Russian strikes in Ukraine and his plan to issue further remarks. That just underscores the ongoing volatility and the deep-seated nature of the conflict.
Absolutely.
So it really raises an important question. What's the feasibility of proposals like a buffer zone without a clear path to addressing core demands and, a willingness from all parties to compromise on fundamental issues like sovereignty and territory?
That question about feasibility feels central to any meaningful progress, doesn't it?
It really does.
And separately, shifting continents again, down in South America, Venezuela has accused the U.S. of threatening regional security with a naval buildup in the Caribbean.
Okay.
President Maduro specifically declared that Venezuela is supported by China, Russia, and India, and that U.S. forces cannot enter the country.
This accusation from Venezuela, coupled with the U.S. naval buildup in the region, certainly heightens regional tensions. But what's truly striking here is President Maduro's explicit naming of China, Russia, and India as supporting nations.
That stood out.
This isn't just a regional spat anymore. It suggests that these local flashpoints are increasingly drawing in and reflecting broader global power dynamics and alliances. It echoes, in a way, the alignments we just discussed regarding the Iran nuclear deal. It really shows how local tensions can become stages for larger international rivalries and tests of influence.
It's clear that these geopolitical tensions aren't just isolated events. They create global uncertainty, influence international relations, and, as we saw with crude oil prices, they have tangible economic impacts. These can affect everything from investment decisions to the stability of energy markets. It's all connected.
Definitely all connected.
Well, that was certainly a whirlwind of insights. Phew. We've journeyed from the subtle shifts in currency fluctuations and the dynamic price swings of commodities through evolving trade policies, some extending, others ending, to complex and escalating geopolitical tensions across multiple continents, from the Middle East to Eastern Europe and down to the Caribbean. It's clear our world is an incredibly interconnected web. So what specific thread from this intricate tapestry stood out to you the most?
Indeed. What becomes profoundly clear from this deep dive is that knowledge is most valuable when it's understood and applied, right?
Yeah.
These seemingly disparate events are, in fact, deeply interconnected, constantly revealing the intricate web of global forces at play.
And as we wrap up, here's something for you, our listener, to truly mull over.
Consider how the interplay between economic pressure, points like, say, a central bank strategic currency fixing, or a shift in critical trade exemptions that fragment global supply chains, and unfolding geopolitical events, such as a proposed buffer zone in Eastern Europe, or maybe a naval buildup in the Caribbean with explicit international backing. How this interplay might not just influence short-term headlines, but fundamentally reshape global alliances and trade routes in ways we're only just beginning to see. What unexpected domino effects could these current events set in motion over the next few months, and how might they influence your own perspective on global stability and, indeed, economic opportunity?
Something to think about. Thank you for joining us for this deep dive into the latest global market and geopolitical briefing. We'll catch you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.